All right, hey everybody, there are three things that I want to cover with you today. So there are some comments last week about my real estate video or my weekly video that talked about real estate. So I want to give a little bit more about that. Apartment REITs, other ways to look at real estate and what they're telling us about real estate. There's some interesting things that happen to real estate when we go into a recession. So that's the first thing I want to talk about. The second is talk about the overall stock market. Is money still coming into the stock market? Is it going somewhere else? If it is, where is it going? So we have to look at that. And lastly, I do want to talk about gold because something interesting is going on with gold that I don't think people really expected. So we'll get to those three things and who knows where else we'll go. So stick around and we'll get to that. All right, everybody, let's jump over to the price charts. So let me pop over to the price charts. And let's first do this. Let's just first look at where money is flowing. Now, here's the thing about this video. Even if you don't care about real estate stocks or gold or whatever kind of the topic I am talking about for the week, what's most important is to really understand that price direction is really something that we have to understand because price direction tells us where the stability is, where the instability is. So these videos are good for everyone, whether you are 30 or 70, whether you own bonds or don't own bonds, whether you care about real estate or don't, have all your money in gold or have none of it in gold. So look at the price chart here. This is the S&P 500. And let's just talk about what's going on. It is going officially, wait for it, sideways. So if you look at the screen, I have a top blue line and a bottom blue line. And the market popped out above, came back in. The market popped below and came back in. But the market is going sideways. That's it. It's not going up. It's not going down. It's not imploding. All it's doing is going sideways. If I look at the whole world, I can pull up a price chart of the entire world stock market. And you can see something maybe similar to it. So if you look at this is VT. Same thing. The market tried to, now this is all world. Market tried to break out of that sideways channel, tried twice, failed twice. It attempted to break down below it, either twice or once. But the same thing is going on, all world. This is all world, the whole earth. It's still just going sideways. Now compare this to, say, Europe. If you look at Europe's stock market, it is absolutely broken down. So it's telling you a different story. Right. So what we know is US is going sideways. All world is going sideways. Now, the reason all world is going sideways is because 60% of the world is the US stock market. Europe is broken down. And let's just quickly look at emerging market. And really, you could look at emerging market this way. And this is probably the best way of looking at it. It clearly broke down, possibly has stopped falling. And the reason I say that is because this is the pre-COVID high right here. The pre-COVID high, and buyers came in at the pre-COVID high. You could even make this channel this wide, but buyers have come in here and they're moving up. It's still in a downtrend. So the takeaway from the stock market is it's going sideways. Not that exciting. I know that doesn't sell newsletters, but that's what's going on. The market is going sideways. By the way, the market actually does well when the Fed raises rates. The market also does well when we have an inverted yield curve. It's typically about 18 months before we have a recession after the yield curve inverts. So that's the stock market. So I'd say money's flowing in, generally speaking, but nothing crazy. Here's the bond market right here. This is the top. This is pre-COVID high of the bond market. And I think your brain can see that bonds have clearly broken down. I want to show you one specific one. Specifically, here's corporate bonds. Again, here's the pre-COVID high for corporate bonds. And guess what? They have broken below. So not good news. So money is really not flowing into bonds. That's not really the place where people are looking for safety. But where money is flowing into is the commodity market. So these are three major asset classes on the planet: stocks, equities, bonds, right? And then the third being commodities. Money is flowing into commodities. Now, there's been a huge spike because of the war. And so right now, the commodity complex is really just digesting that spike. But that's where money is continuing to flow. Now, I can show it to you slightly differently with these three main asset classes here. The red line is commodities. The blue line is U.S. stocks. And the green line, which may be hard for your brain to see, is at the very bottom and is actually negative. So money is not flowing into bonds. The blue line, which is the US stock market, we're calling it sideways, but money clearly is flowing into commodities. Now, the thing about commodities, it's really gotten ahead of itself. So expect a kind of correction back to the mean. But commodities was the asset to be in before, however you want to frame it, Putin's war, the war in Ukraine, the war in Europe was happening. So expect to see maybe a little softness or correction in commodities. But as far as that first topic, overall market sideways, Europe down, emerging market still down, looking to maybe have bottomed. But that's the update on the markets. Okay, next thing I'm going to do is talk about real estate. So someone on YouTube said, could you please look up the symbol LAND, LAND? It's a small company with about it's about a $1.3 billion market cap. I mean, I look at this and it's fairly impressive. It definitely corrected this year from the beginning of the year to say the end of February. It fell, but man, it turned around and it's at new lifetime highs, and those are new lifetime highs. So whatever this company is doing, it may be leasing land to energy companies because this is one of the strongest real estate-like stocks I've seen out there. So it's very likely has something to do with energy also. Also, one of you wanted me to look at some apartment REITs. So here's one apartment REIT right here. It's about $8.5 billion market cap. It came out only at the end of 2020, but still it's up and to the right, and it's looking pretty strong. So I will say apartment REITs, I haven't looked at a lot of them, but this is a apartment REIT and it does look pretty good. There's a couple other REITs that have a heavy weighting in apartments. This is another one. This is the iShares. It's REZ, iShares Residential Real Estate ETF. What I like about this one is it's been around longer, so I can look at it. It's been out since 2007. But again, it's strong. It's right back to its old lifetime highs here. So a break above that is going to strengthen it. Here's its pre-COVID highs here. So that is definitely saying that the apartment REIT area is looking good. And this is also a REIT that has a lot of exposure to apartments, and it's also looking really good. This one is NURE. So apartment REITs are looking good, but you got to look at REITs. I mean, different REITs have different exposure. Here is, this is a mortgage real estate capped ETF, which does not look good. This probably has a lot to do with the U.S. the Fed not buying mortgage-backed securities. So you want to be careful in how you frame or manage or look at real estate. It's not all the same. And here's XLRE, which is the sector, the real estate sector, and that's actually looking pretty good. Last year was the second best sector after energy. This year, up until really the end of February, it was looking really bad. It fell much harder than the S&P, but man, it's gotten right back up on its feet. So if we kind of stuck with is it in a channel or not, that's the channel I would look at. It broke out of that channel and sold off, came back into the channel. Now it's back above that channel. So that's a pretty strong move. So real estate's looking pretty good. And the misnomer or the misbelief is that real estate does badly during recessions. Actually not true. It has a mixed kind of history with recessions. More times real estate has done better than not. And part of the reason I believe is because stocks don't do well during recessions. And so that money has to flow somewhere. And so it flows into bonds and cash and real estate. And I think that's what we might see with the next recession that's coming. The yield curve did invert. That typically means we'll have a recession within 18 months. That's an average. 18 months is an average. Literally, it's like 5 months to 55 months. So the range of where we can go into recession is ginormous. But on average, it's about a year and a half. So somewhere in the next year and a half, we will go into recession. Okay, so that's the real estate. Let me see if I have anything else. The other thing I wanted to show for real estate was just the builders. How are the builders doing? And this is the kind of the black eye in real estate. The builders are not doing well. It doesn't look good from a builder's point of view. That is clearly, there was the channel builders were in, right? So it was in a channel, tried to break out of that channel, couldn't, broke down, got back into the channel, and now it's just not looking good. So from a builder point of view, real estate is not looking good. And that's why how you look at real estate, what angle you're taking is really important. Okay, let me show one more, XHB. I think I have that right. This is a slightly different way to look at home builders, but you see kind of it's the same thing. We have the market breaking down. So how you invest in real estate matters. Okay, lastly, I wanted to talk about gold. So let's just quickly pop over to gold. So here's gold. We're looking at it from a futures point of view. Anything over $1,800 is a really, really important price point to stay above. And the longer gold stays above 1,800, the stronger it is. Now, this is gold priced in US dollars, which is impressive because the US dollar has been absolutely ripping higher. The next metric you really want to see gold above is this, $1,900, which was its high in June of last year and immediately got sold off. What that means is when gold went above 1,900, it really could not sustain itself. So if you think about it this way, gold right here between $1,800 and $1,900 was really having to decide, what do we do? Do we go higher? Do we not go higher? Now behind that, and what I want you to hear behind that are sellers and buyers. So previous to, call it 5 weeks ago, when gold got above $1,900 an ounce, people came in and sold their ounces. It happened in August and September and October of 2020, and then it happened in June of last year. Now gold is above $1,900 an ounce, and people are not selling their ounces. In fact, people are starting to buy. So now the longer gold stays above $1,900 an ounce, the stronger it is. And on its backdrop, let's do this. This is kind of fun. Let's just go candlestick here, and let's go monthly. So we're just going to look at monthly numbers here. So if you can see right there, that's the highest closing monthly. That candlestick right there is the highest closing monthly ever, right there. We are not that far away from it, right? And then if we zoom out, let's zoom out to 20 years, and we can see that was its old kind of monthly high right there, which we're clearly above. So there's still some work for gold to do, but it continues to stabilize. It continues to stabilize over 1,800, and it continues to stabilize over 1,900. Okay, so those are the three things I wanted to cover. I'll throw one more thing in here, and that is, and I'll do it slightly differently because I talked about it a little bit, but I just want to put an LQD. This is just looking at corporate bonds in the US without dividends reinvested or anything. This is literally just the price of the ticker symbol LQD. It's a huge, huge ETF that has $33 billion in it. And again, what I want you to notice is it's below its pre-COVID high. And actually, let me zoom out. Let's zoom out 10 years. Corporate bonds were going sideways for a long time. And then they broke out in the middle of 2019. You had the COVID crash right here, which really, really, really took bonds out. Let me change this from candlesticks to just a solid line so it's kind of easier to see. And let me go out maybe a little farther. But you can see that corporate bonds really didn't do that much here. Now, this price chart does not include dividends. It's just literally the price. So you can see that corporate bonds actually did break out of that big, big channel between 2012 and 2019. Yeah, the COVID just implosion. People were buying corporate because the Fed said they were gonna buy. They actually never bought. And so this is really telling me people are not going into, for sure, corporate bonds right now. And most bonds people are kind of feigning, staying away from, which tells me they may be putting that into real estate and stock or cash right now. Okay, so let's do this. We got to wrap this up. I talk fast. So number one, money is not flowing into bonds. Bond prices are still falling. They've been falling for 2 years. That's going to mostly hurt people over the age of 50 who are following kind of those outdated 60-40 approaches. The market's going sideways. The U.S. stock market's going sideways. Europe's going down. Emerging market has been trending down for a while, may have bottomed. But again, the big news right now is commodities are still the place to be. They were before the war in Europe started, and they still are, but expect a bit of a correction. That was number one. Number two, I just want to talk about real estate. So it depends on how you look at real estate. There is many different ways to slice and dice real estate. Those apartment REITs are looking really strong. Home builders are looking really weak. Stay away from home builders and go for the REITs. And that makes sense because REITs have a yield. Yields are going, or interest rates are going up. Inflation is high, somewhere between 8 to 10%. So it would make sense that those REITs are doing great. And then lastly, really is looking at gold. It's stabilized for now above 1900. This is just in the US dollar. I think the biggest news from gold is that it's actually gone up and stabilized in the face of the US dollar ripping higher. So that's telling you that more buyers are coming in and buying more ounces, or people may be done selling their ounces of gold, which gives gold a good platform. And I've talked about this before in the last, I think, 6 weeks. To see gold at $3,000. But of course, that won't be a straight line. Thanks, everyone, for being in my world. I do appreciate it. I know you have a lot of things that you can watch. Let me know where I got it right. Let me know where I got it wrong. Is there something that I'm missing or an angle that you often hear about that I don't talk about? And if you like this video, you will like our other videos. Okay, thanks so much, and I'll see you on the next one. All right, bye.